Guys, today we have on Guy from Ethena, one of the most well-known and successful stablecoin projects of this cycle. It's also quite good timing. There's been a lot of discussion about stablecoins as of late. Happy to have him on, discuss Ethena's current product suite and also what they're doing going forward, which is pretty ambitious. So welcome, Guy. And if you want to give us a little bit of background, I think people probably should know at this point about Ethena, but just give us a little bit of background on you and then also what you're working on.
Yeah, for sure. Before Ethena, used to work in TradFi, did that for around 7 years. Was working at a hedge fund that focused on like financial services, where we'd invest across the capital structure into basically like distressed banks, payment companies, all those different things. And had got involved in crypto basically at the beginning of 2020, just before DeFi summer was kicking off. So I had a friend who was a founder and founded another application back then and introduced me to the space. I think it was quite funny, like the piece that interested me about DeFi in the beginning, and I'm sure we're going to talk about this topic quite a bit, had nothing basically to do with decentralization in the beginning. I think it was actually coming from a lens of like looking at fintech in the real world and being extremely disappointed with what I was seeing, where it just sort of felt like new front ends on the same back end infrastructure, which didn't actually materially change the cost base or anything to do with those businesses. And I remember just looking at the apps that you saw within DeFi and thinking, this could be like one of the first times when like software scales finance scales at the marginal cost of software. That's like a pretty interesting idea where you don't need 1,000 people to run these things and they can get to pretty big size. So that was actually really the thing that drew me into the space in the beginning, was just more, I thought that these could be interesting fintech type applications. And I think that my view like evolved a little bit through time, where you kind of, the investable universe, I think within crypto actually shrunk quite a bit from when I first came into the space. But that was kind of my entry. And then started out with Ethena around 2 years ago, quit my job. And the inspiration behind it, as I'm sure you've heard, was from Arthur Hayes' piece called Dust on Crust. Yeah. And he basically came out at the beginning of 23 to describe this idea of like a synthetic dollar, which tokenizes basically a cash and carry, which is what people have been doing for many years. And we came out to the market at the beginning of 2024. So it's almost a year ago to the date. And in that period of time grew to the third largest dollar asset in the space. And it was the quickest dollar to actually reach $6 billion in history. So that was kind of our story so far.
Yeah. I think, was Arthur Hayes' piece originally about Bitcoin perps, right?
Yeah, correct. So we had a bit of a different spin in the beginning, which was using stETH versus ETH perps, because I thought it was an interesting way to pick up some like additional carry. And then, as you scaled, the idea was you'd always move into BTC, but you actually kind of wanted to start with the thing that could get the most yield, because that's how you grow the quickest in the beginning. And so, as we sort of grown, the marginal yield sort of decreases when the collateral's not paying you. But it was a BTC idea in the beginning. Yeah.
Okay. So, I mean, like I said, most people should be relatively familiar with how Ethena works at this point, but can you give us like a 30-second to 1 minute rundown of like just, how you launched, in terms of like what the initial product offering was and how it works? Like, assume that somebody is not exactly a trader or really understand how perp funding works in these markets. Just like give us like a very ELI 5, if you don't mind.
Yeah, for sure. So at the most basic level, all Ethena is doing is taking in USDT or USDC. If you get $100 of that, you'll buy $100 of Bitcoin with the cash that you've just received. And then you use that Bitcoin to short $100 of Bitcoin perps on the other side, or futures. The interesting piece about this, and I think is kind of the reason why Ethena grew at the pace that it did, was that this like funding rate, or the interest rates associated with derivatives in crypto, is A, the largest source of cash flow within this entire space, but then also B, had almost like no competition of people trying to tokenize this. And so you had this very weird dislocation between people in crypto who are obsessed with yield, especially on dollars. And this was only like everyone's obsessed with yield, but like no cash flow is actually produced within crypto, if that makes sense. There's only really 3 sources of $10 billion of yield in the space. Like finance equity, cash flow within derivatives, and then Tether. Those are the only 3 sources that you can produce more than $10 billion of like cash flow to tokenize and put into something. And so to me, it felt very strange that this enormous market for funding rates just hadn't been touched in any material way. But at a very basic level, you can think about it as the dollars that are coming into Ethena are essentially like financing the longs for crypto in general. And so we're taking the short side of other positions, and people essentially pay you to get that leverage.
Yeah. So I wanted to ask, why do you think this wasn't ever really tried before. I know there was an attempt on Solana. I forget what it was called, right? And my understanding was that they were using on-chain perps markets, right? So it couldn't really scale. I forget what exactly was the like sort of the hindrance there, why that didn't end up working. But like, why was Ethena able to just like catapult into the lead in this sort of dynamic?
Yeah, I think the mistake. So there were two examples. There was UXD on Solana and then Lemma on Ethereum. I think it was slightly unfortunate timing, just like a little bit too early to the idea and being too focused on doing it purely on chain. So like roughly open interest that you see within centralized exchanges is anywhere between 20 to 25 times the size. And it was just pretty clear that that thing couldn't scale like even into midnight figures if you're trying to do it all on chain. And then the other issue is that on chain is not actually a homogeneous piece that you're interfacing with, right? It's like different chains with different programming languages, different block times, and like actually to aggregate all of the perps that exist on chain is actually a much more difficult like task than it is to just interact with CeFi essentially. And so all Ethena did was sort of challenge the assumption that users would not be accepting of you making trade-offs to interface with centralized exchanges. And we just said, we think we can do that in a not like trust minimized way, but like using these custodians that people could get comfortable with. We just challenged the assumption that you needed this to be fully decentralized to unlock that scalability.
Yeah, I think that like from what I could tell, that was exactly the sort of competitive advantage, was that you were willing to go to these exchanges and make some, compromises. You coming at it from a TradFi background, probably you were like, this is very intuitive, right? But probably for a lot of crypto natives, they're like, no, all this has to be done within this like circular ecosystem, and it just doesn't scale, right? Like the amount of money flowing through those is like just nowhere near what it is on Binance and Bybit and so on and so forth. Okay, so then, all right. So I know you describe USDE as like this, kind of synthetic dollar. Where do you view this falling in the long run in terms of like, we have this massive boom of, stable coins, and everyone seems just like super excited about this right now. It's sort of the talk of the town. There's a lot of people who are also like, this isn't necessarily investable for retail, right? Like this is the first time we found some clear, semblance of product market fit. And it's like, okay, so how does retail get any access to this? That we can put aside for a second. Where do you view the role of something like USDE in the context of USDT and USDC and all of these, competing stables at this point? Like, where is your edge? I have my own answer, but I want to hear yours.
Yeah, I think you can broadly categorize like the use cases for stables right now into 4 different buckets. So one is just trading collateral on centralized exchanges, which is actually the biggest use case. If you just look at the way, like, where is Tether actually sitting? You've got 60 billion that's sitting on Tron, and then basically 80 that's sitting in centralized exchanges to trade derivatives. So as much as we sort of like this narrative that it's like used for non-speculative use cases, the biggest use case of stables is still to facilitate speculation. Then you've got developing world store value sort of use case, which is just providing dollar rails to people who sit outside of the US banking system. I think that one's pretty obvious. And then you've got payments and like savings technology as 2 other buckets. The 2 first ones that I described, I think, are really the big use cases that exist right now. And I think just very simple examples with Tether on Tron at 60 bill, Tether sitting in centralized exchanges at sort of like 60 to 70-ish bill. Those are the 2 dominant use cases that you have to go and win. And the payments one, I think, is extremely small now, but will become the most competitive going forward. The way that we looked at the world is actually saying, you as a startup need to be extremely like honest with yourself to say, where can you actually compete with businesses that are the size of Tether, and actually ask yourself a very serious question of, what are you doing that's 10 times better than they can do? And for us, it's actually in those first 2 use cases that I described, if you're going to be saving in something that's producing 18% annualized, you could argue is better than something that's producing 0. And there's obviously a different risk profile, all these different pieces, but I think that there is some argument that producing like a structurally higher return on those dollars is a useful piece of like savings technology for people around the world. And so I think that savings sort of like use case there is somewhere that Ethena can clearly compete just because of the return element that sits within what we're doing. And then the trading collateral use case is really the approach that we took differently to other sort of, call it on-chain or like DeFi originated stables, where we recognize that the biggest like determinant of a successful stablecoin is not determined by users, it's determined by Binance basically. And you as a user don't decide what stable you're using on Binance. You get told this is the stable that you can use to trade the BTC and ETH pair. And that's, I think, the piece that people don't understand around the structural moat that Tether actually has, which is it doesn't matter if you're paying people like 4% T-bill yield on Binance. They want to hold Tether because it costs them 1 basis point less to get into the BTC pair. And an HFT, a market maker, when they're trading the pair 10,000 times a day, couldn't care less about like 4% annualized. And so I think this is like a big mistake that new startups are making, VCs are making, which is thinking that you can recreate this like amazing success story of Tether, where really their success came at a very unique moment in time, which was driven by like microstructure reasons that you'll never be able to recreate. And everyone, I joked with someone the other day that I thought investing in or starting a new vanilla stablecoin issuer now is kind of like raising an NFT or metaverse fund in like November 2021. That kind of feels like that moment to me, where everyone thinks that these are just some incredible businesses going forward. But if you actually look at the unit economics outside of Tether, I think a lot of them are actually pretty terrible businesses going forward. So the short answer is that we don't really want to be a payment stablecoin competing with a PayPal or a Visa or a MasterCard. We're always going to lose that game. The game that we can win is like derivative collateral within crypto and savings technology for the rest of the world. Yeah.
Okay, last cycle we had Terra. I'm sure you've been asked about this a million times. I remember when Ethena launched, there was a lot of people drawing comparisons, which were factually poor, right? Like, I mean, just it's not anything remotely similar to Terra, but there is, as you mentioned, a different risk profile. Explain in like the simplest terms, in the way that your lawyers will allow. What do you view as what do you view as the biggest risks to Ethena and to the protocol as a whole? Like I don't know, once again, this isn't exactly my domain. I'm not really a trader, but like I've always looked at sort of like counterparty risk or execution, like on potentially massive trades as being one of the bigger risks. And again, part of the problem is that we had a stablecoin last cycle where it was very binary in the sense that it was worth either $1 or it was worth literally $0, right? Like it was programmed to be worth one or the other in a sense. And it obviously ended up being worth exactly zero, as it should have been. That isn't exactly how Ethena works, but there are some, as you mentioned, different risk profiles. Like explain that to somebody who may not be like so aware as to how like different stablecoins may work.
I think you're one of the ones actually calling for a potential blow up. I think you said it's either us or Eigenlayer that are going to blow up at the end of the cycle. So we still have some way to because neither of those have happened. I think the key risk that you're pointing out is actually the correct one, which is like counterparty risk to centralized exchanges, offshore unregulated exchanges. I think the piece of infrastructure we put in place to try to deal with that is this concept of like off-exchange custody, which you might be familiar with, where essentially since FTX last cycle, you can disaggregate the collateral from sitting on an exchange where you're actually executing and settling. So you can actually hold all of the collateral outside the centralized exchange while still using it to margin the derivatives for the hedge. That was a very key piece, and I think it actually came to light during the Bybit hack like 2 weeks ago, because if you remember when that happened, like the entire timeline went, all right, Athena's about to blow up type thing. And I think it was just an extremely strong demonstration during that period, which is like, actually, this is why we put these pieces in place. And even if Deribit went down, we only had basically like 30 mil of unrealized exposure to Bybit during that period of time, which was closed down within an hour. And so it was basically like a 50 basis points loss that we would have incurred with an exchange that had 20% of the book sitting inside of it. So I don't want to say that risk is zero, but I think we've been quite thoughtful in terms of how we try and approach that risk. And I think going through a period of what you've just seen with largest liquidation in history was like 2 months ago, and then Bybit hack happening like a month ago, it feels like we are sort of gaining a bit more trust, I think, in the market in terms of, I don't know, just the risk profile that they sort of view this in. I would also say that like, I'm not going to compare like offshore exchanges to regional banks in the US, but like this custodial risk actually exists with everything. It's just sometimes it's not extremely like obvious to you. So the reason that, Circle was in trouble when SVB went down was that you assumed SVB credit risk was, negligible when it wasn't. And so, I would just say that these things exist, but they're sort of being transformed in different ways. So you're always facing some sort of custodial risk in some format. We think that like crypto custodians in the context of having it in a smart contract or sitting on a centralized exchange is probably the best of the three that you can sort of achieve within crypto. And maybe it's a controversial thing to even say that like your money is safer within a copper, which is the custodian that we use in a bankruptcy remote SPV, than it is sitting in like a new smart contract. That's my view. I sleep better at night actually with the money sitting within custodians, but I know that probably won't, many people won't agree with that. Yeah.
I mean, you probably have some recourse with copper. You don't really have any recourse with Lazarus. So, I mean, like, these are just things that the market has shown us at this point. Like, there's definitely trade-offs. And I don't think that would have been controversial in like 2019, I think, very much so. I think people, especially as more institutions or whatever are being onboarded, I think it's like quite a reasonable take. This is like a bit adjacent, like a bit tangential, but yesterday, there was like this, thing on Hyperliquid where there was this trade, and what ended up happening is basically Hyperliquid just like canceled an order that they had exposure to. This is like adjacent. I'm not necessarily relating this to Ethena at all, but like, how do you view this type of thing with centralized exchanges? And then, maybe Hyperliquid a bit as well, but like, how do you view this kind of dynamic, and especially in the context of like users? Like, what do you think that users are expecting going forward? Because there was a lot of pushback yesterday. In fact, it was maybe the first time that I've seen people get a little bit, like turn on some of the people who end every tweet with Hyperliquid. Yeah. Maybe it was the first time that I saw a little bit of pushback. I'm interested because this is now kind of like bridging into that, territory of like some discretionary ability for custodians, maybe not exactly the word, but exchanges to make decisions. How do you view this in terms of like security and risk going forward, like just building out these systems?
Yeah, I think it was obviously pretty unfortunate what happened with Hyperliquid, and I know obviously it's a difficult thing to do, to ship at the speed that they are with the size of team that they have, and like do everything perfectly, because to manage the risk on like what they've built is not that easy. The one piece I would say is that my sense is that users are actually fine with a team or some entity in the background having some level of control, because actually when shit hits the fan, actually the outcome that you want is that normal users don't lose money, basically, is kind of like the outcome that you want. And if people are stepping in, yes, it's not great that there's an ability to do that, but I think that that's like the outcome that people should be solving for. I think the issue that people had specifically as it relates to yesterday was it's not actually clear to people from the outside in, because it's closed source code. No one actually can see under the hood what actually are the controls that the team has in the background. So I think the very specific piece yesterday was resetting the Oracle price to a price that basically screwed over the guy who was like manipulating it. And so there's actually a full spectrum of what they could have done, right? There was one which was, we'll close the market at fair market value, which would have meant a loss to HLP. But they actually went one step further, which is we're going to close the market at a place where the trader who was in the money, lost on paper. And I think that that's just one piece where you could, if you are clear to users up front to say, we have these controls and these are like this is the framework in which we would actually step in to do something, and then you do it. I don't think people actually have an issue with that at all. I think it's just when you're surprised by things. And we even found that ourselves, I think, on the Ethena side, which is saying, your assets are sitting within these custodians, and like you don't actually have like control of your assets. You've sort of given them over to the custodians. But I think as long as you're telling people that that's happening and they can sort of read it before they come in, that's it seems to me to be something that's acceptable to the market. Yeah.
Okay, I want to ask one other like sort of just basic question, and then we can start talking about more interesting things. But let's say that there's a 10x in the size of crypto market cap in the next 5 years, and one thing that you probably noticed as of late is that there's a lot of discussion of Coinbase perps. Robinhood is coming into the market in some capacity. It would make logical sense that they would get into perps. This is like probably quite in their wheelhouse. Perps, as you mentioned before, have been one of the very clear product market fits. Like trading these assets is ironically like one of the, the circularity is ironic, but it has very much been one of the product market fits. How do you view Ethena competing with Robinhood or Coinbase launching a similar product? Like, where is your competitive advantage going forward if they're able to create a synthetic dollar? Like, where do you guys see you fitting into that sort of framework?
Yeah, I think our advantage actually sits in like our neutrality. And this is a piece that exchanges get wrong the whole time, which is they all want to list their own stablecoins because everyone just thinks it's like a free money game to have your own stablecoin. I think the thing that people don't realize is that they're actually completely useless unless they're used across every venue. So like even Binance's FDUSD, for example, it's in the low single digit billions, basically. I think it's like 1.5 billion right now. We can check. And for an entity that's holding $130 billion in assets and $40 billion in other people's stablecoins, I think you can look at that and say it's actually like a failure in terms of the size that it is relative to Binance. Why is that? It's because people don't want to hold FDUSD on Binance, swap into USDT to go to OKX and buy it afterwards, especially market makers and HFT funds. And so every time you're trying to sort of like capture your user with your own stablecoin within your own environment, it's just a net worse user experience for everyone who's on the venue. And so this is especially true for Ethena. So we did have one of the centralized exchanges actually copy Ethena's product, and it scaled to 600 and something million, and Ethena was obviously like 10 times the size of that. Key piece about this is like being able to move cross exchange, but then especially so with Ethena, which is you need something in the middle that looks and feels honest, which is not like the centralized exchange running it themselves, right? Because an exchange taking in like users' dollars and then saying, we're hedging this in the background on our own exchange, here's a receipt token, and like, trust me in the background that it's been hedged. That's kind of like a little bit like Alameda in a box, right? It's not it's difficult. And so the actual beauty of Ethena is that it's external to all of these exchanges. All of the exchanges, you can almost think about it like a small, like 5 validators who are making sure that this thing in the middle is being honest, because they really do care if we're fucking up on a different exchange. And so that's actually like the value with this specific product, which is specifically we're not like aligned to one exchange. We're actually trying to be aligned with all of them, if that makes sense. Yeah.
Everyone's launching a stablecoin right now. Like everybody, every single day you see 10 new. I mean, like Wyoming launched one, Trump launched one. Is your view in the long run that there are hundreds of stablecoins, or that there are very few? And then secondary follow on to that, what about the whole like abstraction thing? Like, how do you feel about, are you going to be sending somebody USDT and it shows up in their wallet as USDC, or are we going to, all converge around a single sort of unified stable, like single stable coin?
Yeah, I think the unfortunate outcome we're going to arrive at is like suboptimal, and it's going to be driven by like ego, basically, which is we're going to have a power law outcome like we see right now, with 2 or 3 dominating like 90% of share. And then you're going to have a long tail of like literally thousands of them, where every single entity in the world thinks that they should issue their own, and that they should own their own because like their brand is so important, or whatever reason there is sitting behind wanting to sort of have the brand in it themselves. I think that like the perfect user outcome for this entire thing is something like Circle basically just says, we'll give 99% of the revenue to anyone who wants to come within this network, and we'll take 1 basis point. What we're going to end up at is every single fintech, every single Web2 business, every single financial services business in the world is going to launch their own, and they're going to realize that no one wants to use your stablecoin outside of your own network. And the moats that like Circle and Tether have built within crypto are pretty much impenetrable for like new people to come in. And I think you've seen that with PayPal, for example, struggling to get over 500 million. I think that it's only going to be useful and sort of used within their own like closed loop systems, essentially. Yeah.
Yeah, but why has it taken so long? I mean, obviously there's like clear regulatory hurdles, but why has it taken so long for Tether or Circle to give anything back to users, right? Like, is it because part of my like thought process is because you can easily just get yield in DeFi or on centralized exchanges? Is that like, I mean, that has to play some part of it, right? But like, why has it taken so long for there to be any discussion of this, right? Like of sharing 99% of revenue, like you said.
Yeah, so I think for Circle specifically, obviously Coinbase had been kind of doing that through like marketing arrangements. If you remember, if you leave your USDC on Circle, you somehow get like a marketing reward which like tracks T-bills perfectly, which was a big coincidence. And then Tether has like a policy that they will never share yield with anyone, and that's as far as I understand like the policy that they continue to do even with the larger centralized exchanges. I think the piece, and this is why Tether is such an amazing business model, is that it becomes a very slippery slope when you start to share the yield, because it's like, where do you draw the line afterwards? Like, should that number be 50 or 60, or should it be 99 like we just described? So yeah, I think that that's like part of the reason why it's taken a bit, was just it's been happening in the background a little bit as Circle sort of like chipping down with different exchanges to share more. And I think the other piece that people don't understand is that Ethena is like the yield bearing stablecoin for Tether, if you think about it like hard enough, because we basically use like 70% of the backing within Ethena is like using USDT margin perps. So like when we're going short on a USDT perp, we're necessarily creating $1 of Tether demand to come long on the other side. And so actually a lot of, when I say Tether is used for speculation within crypto, a lot of Tether is actually just sitting there shorting perps to collect the basis themselves. It might not be Ethena, it can be other people who are doing it. And so that's actually like the yield bearing version of Tether. It just hasn't been productized by them to push it out. And in essence, if you actually go like down the daisy chain, Ethena in some format, you can sort of think about it like every dollar that we go up, Tether goes up by 70 cents. And in essence, we're kind of like a yield bearing version of Tether, if that makes sense.
Yeah, it does. Okay, so I wanted to ask you about something that has long been a thought in crypto, which I personally disagree with, but I'm interested to hear your take. There's been this thought that like anything with an oracle price, like anything that can be priced on chain, could in theory be used as a currency. And I think the rationale for this is just like all of these, stable coins or crypto assets, we could end up just paying with any of these or using any of these as, collateral or, like a money of sorts. You said you're not going after payments for the time being. Like, you've very much seen yourself as like a sort of a trading focused stable coin or synthetic dollar, right? Why wouldn't in the future people just prefer to hold something like, USDE and use that functionally as money?
Yeah. So to be clear, we definitely do want to do that. I think it was just more around the sequencing of like, what are the big pieces that we can win first? And then how do you just think about the ordering in which you go chase them down? I wrote at the beginning of the year, I had a roadmap piece that I put out, which I can share with you, where we spoke about how we're trying to like broaden out into other distribution platforms. And one example I gave was like Telegram, which I think is particularly interesting, where at the moment you can actually, as of like the end of next month, basically just hold USD within your custodial wallet within Telegram next to Tether. You can send it to your friend without like wallets. It's just sending like a name tag basically to your friend to send money. And then you can save within the same token and then spend with Apple Pay with your token sitting there. And so if you take one step back, this is like 95% of financial services for most people on earth, right? Is I just want to hold $1 in my wallet, get a yield and spend it. Like that's it. That's all people want. And you're kind of achieving all of that with just a single token sitting within a wallet they use or like a messaging platform they use every day. So to me, that's actually this is a very cliche thing for people to say, and it's almost like cringe for me to say it, but like this is genuinely a product that I believe like 1 billion people can actually find useful out of crypto, is what I just described there. And so I think for us, it's what I was saying now was less, we're going to go and actually try and compete in the normal payments and financial services like industry against like $400 billion companies like PayPal, MasterCard, and Visa. It's actually, we can be useful for these payment functionalities, but it's going to be sitting in something which isn't a financial services business at the moment, if that makes sense. So sitting in the back end of a Telegram and different platforms like that, where you can actually integrate what we're doing without explicitly going to sort of compete as payments technology.
Yeah, for sure. And I think it seems much more intuitive to say that something like a yield-bearing stablecoin could ultimately be used as a pure medium of exchange versus something like, some of these wild idealistic views of like, oh, you'll just be paying with some portion of Apple shares. It's like, no, that's not how it works for many reasons, right? But if we were going to use something that's not functionally a literal dollar, but something similar, it seems much more intuitive that it would be something like a yield-bearing stablecoin that has, at least the ability, like if you were thinking about this at a macro level, like to preserve your purchasing power, even in small increments over time, right? Okay,
I mean,
so go ahead.
That is almost like your deposit account at the bank, right? It's just not a very high yield. Like you're constantly accruing that yield until the moment you spend it. And that's actually one small inefficiency with the payment stuff that you see within crypto, is that you have these gaps in terms of like not earning interest down to the very last second until you actually spend it. But I think we're like, it's already there. You can actually plug and play this on an EOA on Ether Ready, where you can plug in a card, and whenever you want to spend SUSD, it essentially swaps into USDC and an AMM in the background, and then sends the USDC to the merchant who can receive that on the other side. And so you can actually kind of turn anything into like money, so long as you have like a route into USDC, which can be accepted on the other side. Yeah.
Yeah. I think one other problem, just like slight side note about that, is that like for a lot of these, there's like very idealistic visions of, being able to use anything as currency, but like the whole headache of like capital gains and appreciating assets being used as currency is like not viable in any short time frame in terms of like how taxing and like regulation works. It's like, it's not, you just don't want to be paying, like ordinary income on every, like short-term asset you've purchased that's gone up in value. Like, so unless for some way we were able to completely remove, like capital gains tax from like, just like the vast majority of assets, it's like, it doesn't really work like that functionally. But I could definitely, what I'm saying is like, I could definitely see a compromise where something like a yield bearing like stablecoin that has some type of like, algorithm in the background that's creating this like that this yield is like much more intuitive than, like what a lot of crypto people have seen for a long time. The only reason I bring it up is because like that's been a like talk in crypto since I can remember, like 2017. Yeah. I'm like, oh yeah, I just don't really think it works like that. The Gwart Show is sponsored by Ellipsis Labs, who I've been following for 3 years now. They're one of the strongest teams I know in crypto. Ellipsis Labs is a small engineering team with a flat structure. They build complex systems, primarily in Rust. For engineers who like challenges, here's the kind of problem they solve. A layer 2 blockchain needs to maintain 100 million accounts and generate a state root after each transaction batch. The root must be built within 50 milliseconds. How would you design a system to ensure the root construction is fast enough? High-performance challenges are core to Ellipsis Labs' mission as they build modern crypto finance. They believe finance needs more than an upgrade. It needs a complete rewrite. The success of their first product, Phoenix V1, speaks for itself, doing over $70 billion in organic trading volume. Now, Ellipsis Labs is building Atlas, the blockchain purpose-built for verifiable finance. I know this team personally, and I like them because they're unique in the crypto space. They have a long-term focus, they work in person from their New York City headquarters, and they're here to build products that fundamentally change the world of finance. If you want to learn more about their open roles, go to ellipsislabs.xyz/careers. Let's talk, okay, so you're launching Converge. This is your new chain. Give me a rundown of this.
Yeah, I think the super high level thesis that we have here is that there's kind of 2 use cases that we see for blockchains right now. You've got settlement for speculation, which I think you can just see with meme coins on Solana or derivatives on Hyperliquid. That should be pretty obvious as just a use case that exists now. And then I think the other big one is settlement and storage of stablecoins and then tokenized assets. And I think that this second category, if you actually believe that like the crypto thesis is real, you should believe that that second category that I just described to you is a much bigger one than the first in the next sort of 10 years. And it's the one that's actually much earlier in its sort of life cycle, in my view, where really like no financial assets exist on chain. You've really only got like T-bills right now at very small scale. And the speculation one you sort of feel is getting a little bit like long in the tooth, if you know what I mean. Like we can even look at very basic metrics, even where alt market cap peaked in 2021, Q1 24 and Q4 2024. It's basically the same number, like the same notional number. And to me, that was very like indicative that we've kind of found out how much retail money there is in the world to sort of speculate on what is 99% just complete vaporware garbage, right? And we're hitting the same number 3 times in a row, which to me is a pretty strong signal that like we're running out of sort of steam on that side of things. Anyway, just like taking a step back, I got a bit frustrated, I think, in the last year or two, just operating within crypto, where it did not feel like we had real net inflows into the space in any material capacity. You really only had ETFs buying BTC and then Tether supply going up by 60 bill. Every other metric is kind of down in some format or has been reshuffled from chain to chain. So if you just look at like DeFi TVL in total, it's down like 40% from 2021 peaks. And yes, there's been a reallocation where some has been lost from ETH to go to Solana or whatever it is. But in essence, we've just reshuffled the same chips like around and around to each other. And I think the view here is like, we've got a product that I think is actually uniquely interesting to TradFi, which is like $1 with an 18% annualized yield. And the demand for that product is not like 5 billion. It's like north of 100 if you can deliver to them in the right format. And we want to basically just go and build the infrastructure where institutions can come on chain, actually consume our products and interact with the stuff that we're building here, and not sort of wait and sit back and allow that and just sort of like hope that happens. And we think that we have like the core killer product, which is the initial product that we came out to market with and obviously found success in the last year. And we're essentially teaming up with Securitize, who's obviously the tokenization partner for BlackRock. And the big thesis that we have here is that we're really working together to bring assets in different directions in what I think is a pretty unique and interesting way, where Ethena is taking crypto primitives, wrapping them up in a format that you can export out into TradFi, which brings us inflows. And then Securitize is taking tokenized assets from the real world, bringing them on chain, and then asking what financial infrastructure can we build around this to make them more interesting. So you're really coming at it from like 2 different angles, where you're bringing, 2 opposite ends of the stick between DeFi and TradFi together, and sort of building within the same block space as you do that. So that's like the super high level view of what we're trying to do. And I can, jump into any piece of that you want to talk through. Yeah.
Yeah, for sure. So is this an alt L1? Is that how you would describe Converge?
We're literally coming out with like expecting like 3 days. So if I could just hold off on that one, we're basically running through all of that stuff in like 3 days. We haven't actually come out with that fully. Yeah.
Okay. Well, then I can ask a slightly different question. Why did you feel that you needed to build your own infrastructure. What were the limitations with the infrastructure that you're currently working with? I see you have recently branched out to working with Solana, working with Pump. You obviously come from like a very pragmatic background. Like I think it's like very visible to anybody, who's seen what you built and like heard what you say, right? But yeah, what were some of the limitations maybe working with the current infrastructure and why you felt like you needed to build this yourself?
Yeah, I think we obviously launched on ETH1, and the very specific reason for that was that the most amount of money was just sitting on ETH1. So if you wanted to scale Ethena from 0 to 10 billion, we had to do it there and not Solana. And there's like market microstructure type of reasons as well for that, which is like borrow rates for dollars. If you go look on Aave, is always like 500 basis points to 1,000 basis points cheaper than like when you go to Camino or like some L2 and that kind of stuff. There's very like small reasons for why it was just much easier to accumulate like $10 billion of assets sitting within ETH1 versus somewhere else. What I would say is that if Solana had 100 bill of TVL when we were launching, we probably would have started there. I don't have any like affinity to where we sort of launched the product in the beginning. And I think this is actually a bit of pushback that we got when we expanded to Solana, which is we got quite a bit of like pushback from the ETH community. And like, I think people don't understand that it's not my job to walk around and tell people like where they should be operating and where they should be using products. It's my job to listen to what people want and go and deliver them products in the places that they are, basically. And so that's really like my role, is to actually just go around where there is demand and actually deliver it there. So we're pretty unopinionated from the chains that exist right now. I think the pieces that comes to like why we're capturing this internally is like actually me just trying to challenge like a bit of a narrative that's in the market right now, which is, ETH has lost the speculation use case to Solana and a bunch of different other chains. And I think it's hard to argue against that fact that like, speculation doesn't really happen on ETH1 at all. And I think maybe only base to some extent. And then we sort of fall back in this narrative of like, hey, but like institutions are coming here to build on ETH. And that's like that's the narrative that's keeping it like up and afloat right now, right? Which is like there's, BlackRock and whoever else is doing stuff on ETH. I think there's a very big difference between these people bringing their products on chain to sell you, which is what's happening with T-bill products, right? They're bringing their product and you're putting your money into it and they're making money from it on the other side. And there's a very different proposition, which is, do you as an institution want to put money into my product and actually grow my product that sits on chain? Is a completely different thing. And I think that's what we're wanting to go and capture. And I think the piece that I am challenging here is that I do not think institutions are just going to build on ETH just because they were here in the beginning. I think the people that decide that are the people who build the products and the issuers of the assets, i.e. Ethena and Securitize. That's who's actually going to decide where these people are going to come and do things. And so, yeah, that's the piece that I was sort of challenging. And I think, it's more that we can sort of capture more value to ourselves, like owning this. And I think that actually the ownership of this and like who decides the outcome of how this looks sits more at the application level and the issuer level. Yeah.
Did you feel like any of the cultural aspects of Ethereum were like I kind of alluded to before, like limiting, or did you get jaded at all by that? I mean, obviously, like the past 2 years, like there's been a ton of pushback on. It's like quite tired discussion at this point. But every time I talk to like a founder who's building or has built on Ethereum, I think I've heard a lot of the same sort of points of discussion. Like, did you feel jaded at all, or were you kind of like in a point where you're like, guys, like what you just said, right? Like the values and who issues the assets and like who builds these products, and like this is not working for us. Like, did you have any did you have any thoughts on that?
Yeah, I don't have any bad feelings, resentment or anything towards ETH. Yeah. It's just more I think a very clear example here was actually when we were coming over to Solana. Like the BD arm at Solana is like feels very professional and business-like, where you get thrown in a group chat. It's like, here's a Google Doc. Here's $10 million that we can seed this pool. And it just feels like you're efficiently getting through things to get things done and actually deliver products. No one actually within Ethereum interacted with me for basically like 18 months until a few months ago. And, I would have thought that we're one of the more material things that sort of happened on ETH1 in the last few years.
For sure.
I literally did not speak to one person until we were like 18 months in. And so to me, it was just a very different approach, where on one side you felt there were business-like people who are trying to get outcomes and build products for like real users. And then, I think it's just a bit more of a distance approach from the other side. So I don't have any issue with that approach. I'm just sort of describing what it's like to sit on the other side, and you can see why more things get done elsewhere. Yeah.
Well, who finally spoke to you 3 months ago?
Met Vitalik for the first time a few months ago. Yeah.
And what was the? I don't want to probe if you don't feel comfortable sharing too much, but I mean, do you feel like he has a sense for bringing and keeping businesses on the L1, or is it sort of secondary in his mind?
That I don't know enough about. I'm not sure. I think that he probably wants more of that to be done by the EF, if at all. I think we just have slightly divergent views in terms of what are the products that people want. And I think this even came out in some of the thought pieces that he put out himself around how he thought about DeFi, being quite circular, speculation. He's obviously not a big fan of all those things that are going on. I think the slight paradox here is that most of the value in ETH basically comes from the existence of DeFi, and whether you like it or not, ETH would probably be $200 if DeFi didn't exist. And yeah, I think that's the I actually see a lot of merit in the arguments that he's making around the circularity around a lot of the stuff and the unsustainability around a lot of it. But at the same time, I think we also need to recognize that some of the activity that's happening there is also what actually gives value to any of these base layers as well. So yeah, I also think that, even just the nature of what we're doing at Ethena, it's a pretty offensive thing, I think, to OGs within the space. And, someone like Vitalik, who's so focused on decentralization, we came in and we said, we're going to create a dollar adjacent asset that connects into centralized exchanges. That's pretty much one of the most offensive things that you could actually say to someone who's built with the ethos that they've had through time. So I don't sort of hold it against them. I think we just have different views on what users want. Yeah.
Yeah, it's quite interesting too, because if you go back and listen to a lot of the talk around, especially the merge, I remember hearing this, one of the big selling points for ETH, the asset, was as collateral, this pristine collateral for decentralized stables. That was one of the narratives. I would say top 2 or top 3. That was the premise, right? There's going to be an emergence of decentralized stable coins. And this was the ideologues were all, gung-ho about this. And this just did not come into fruition. And there's a number of reasons why, people say capital efficiency. Some people argue against that. What is your take? Why have decentralized stables just never taken off? And not just never taken off, but they've continuously lost market share. Is there any future in this?
Yeah, I think they're just not solving for the things that people care about. So with a stablecoin, there's actually only 3 axes you can think about. And this is also why all of the new issues that are coming into the market, I sort of have the same bearishness that I was describing to you in the beginning. There's only 3 axes. So there's how stable are you around $1? And if you can't do that, then you're out of business pretty quickly. The other one is liquidity, and you're never going to be more liquid than USDC or USDT. And then the third axis is return. And that is actually a wedge that you can actually create within the market, because either Circle is constraining themselves with just T-bills and not longer duration assets that can pay you more and generate more. And then Tether is just deciding as their business model, they're not going to do that. So that's actually the only lens that you can look through this as a new issue within the market, which is I can only compete if I have incumbent distribution, like a payment network that's just going to put it within their own system, or I'm going to pay people more with the reward that you can generate. And then you sort of look across crypto and you realize there's actually only 3 sources of yield that you can put into these things. You've got T-bills, RWAs, you've got over collateralized lending within DeFi, and then you've got CeFi perps. And that's all Ethena did, was we came into the market. And if you think of those 3 buckets as well, all you're doing is actually lending to people. That's all stablecoins are. The first example is you're lending to the US government. The second example is you're lending to over-collateralized degens and DeFi. And then the third example is we're lending to degens and CeFi. And all we did is come into the market and say, no one is lending to these people and they're getting paid 20% annualized while our base at 8. There seems like an opportunity here when the market's $110 billion in size.
Okay, I want to come back to Converge. I got a little bit sidetracked there. I want to come back to Converge now. You're working with Securitize. What do you view as the main assets? If I know you said you're going to drop more information on this, but anything you can share now, what are you excited about? RWAs, T-bills, maybe less exciting. Perps, obviously. Where are you guys going with this? Sell me on this.
Yeah, there's a few different angles. So we have this product called USDE, which is coming out in basically the next couple of weeks. And I've written about this at the beginning of the year. It's basically a regulatory wrapper that sits around USDE that we can actually put it in a format that TradFi can consume. So you're basically tokenizing it as a security, and then putting KYC and permissioning around the asset. What's interesting about that is you can then deliver it to people who sit outside of crypto, who don't touch crypto rails at all. So you can basically go to Securitize as like an investment manager and say, I just want to send you fiat and like get the replication for like the underlying return that's being generated here. I don't need to touch USDC. I don't need to do anything. You just put money into a bank account for a fund manager. And that to me is just such an enormous opportunity, which is like, think about the size of demand for dollars that sit within TradFi at even single digit yield. You've got something here which is uncorrelated to the yield and returns that you see within TradFi that can scale to multi-billions. Anyway, the interesting thing about this is that this is like the core asset that will sit within the chain, which is all of the areas that we found product market fit within USDE, within DeFi, you can do within a TradFi context. So when you take something and you use it as collateral on a prime broker, you can actually take this asset in TradFi to use this as a collateral when you're trading whatever else you're doing over there. The leverage stuff that you're seeing within RWA or on money markets, where you actually lever the exposure that you have by sort of borrowing dollars elsewhere. What happens when you open that up to investment banks or commercial banks in TradFi who can lend at like SOFR plus 200 basis points instead of SOFR plus 600, which is what you're getting from RWA. And so all of these like pieces of financial infrastructure that we've built within DeFi around USDE right now, you can actually replicate with this asset going forward with all of these other people that sort of sit outside of the system. So that's like one key piece around how we're trying to actually get new inflows around the stuff that we're doing at the moment, but like really focusing on them as like a user group or like, institutional users on the other side. From the Securitize perspective, yes, it started with T-bills, but actually their ambition is to basically just bring every asset on chain. And I think that equities are probably the one that I find the most interesting. I think that there is like a $10 billion opportunity basically to go and build perps on equities. To me, it feels like a very logical end state for where leveraged retail speculation on equities go, which is, it doesn't make sense that retail users are underwriting like the Greeks on options on Robinhood, and the only person who's winning from that on the other side is Citadel. And to me, the perp is actually one of the few financial innovations that have come out of crypto that is just better than what you find in TradFi. And my view is that within the next 12 to 24 months in TradFi, this is going to be legal to use perps in the US. And doing it on equities, I think, is like a $10 billion opportunity, which you could actually do pretty interestingly, I think, within crypto, which is kind of like let's do it quickly and more aggressively.
Just curious, why do you say 10 billion? Like if what you're describing is like, if I'm understanding what you're describing, it seems like it should be much, much larger than 10 billion, right?
Yeah, sorry. I mean more in like a crypto context, which is like, things that have been successful this cycle are $10 to $20 billion in size. I think that this is like an opportunity for a crypto app that can kind of get to that scale that I'm describing there. Yeah. But I think, Robinhood will probably win that market themselves and become north of $100 billion company in the process while they're doing that. I'm just saying that like the number 2 or 3 who's behind them, which is kind of where I see the market structure for this going, can be a $10 to $20 billion opportunity. Yeah.
That's interesting. You say like, you think Robinhood wins that, but then there's, the pie can grow large enough for other competitors. How do you feel about that? I don't know, ideologically, like, how do you feel about, because this is obviously something that has been now discussed, I would say, especially in the past few months, right? Like as we're watching a transition to some new regulatory environment, whatever you want to call it, and we just see these new actors coming in, it's like, oh man, like Robinhood's going to run away with this, right? And like, where do you view, like, do you have some reservations about, pulling up the ladder and like regulatory capture, right? Like this has to be concerning for somebody who built, at least, right, like crypto native. Maybe some of the original crypto natives didn't love the angle you took, but now you got even, more centralized entities, the most centralized entities, if you will, coming in and like scooping out a large part of the market. And like, how do you compete when Robinhood can allow users to trade perps on Tesla right from their phones?
Yeah, I think it's a very difficult thing to do, but this is like what happens when you're playing in big boy markets with like big companies, right? You're fighting for big prizes and people are obviously going to compete. So I think with like, as it relates to the Ethena product, I have very little concern that like new entrants into the market will be able to recreate what we do or like undermine us in some way. Like as I described in the beginning, like Robinhood coming into the market and trying to do what we do, they're actually at a massive disadvantage to us versus being like this neutral piece of infrastructure across all of the exchanges right now. I think as it relates to the piece around the perp equity stuff, I agree with you. It's very difficult to do that. But the interesting thing about big markets is that actually like the number 2 or 3 can actually be an enormous outcome in and of itself. And especially when you're working within crypto, if you go speak to, by the way, the guys who are running the number 2 and 3 offshore exchanges, they love their position. They don't want to be like number 1, which is like where everyone's giving all the attention and like, people are coming down on you much harder. And all of those guys are billionaires as well. So I think the number 2 or 3 market spot is actually kind of the ideal one, I think, within crypto, which is maybe an unspoken thing. Yeah.
What do you think? This is a bit of an esoteric question, so I don't know how well I'm going to ask this, but like, what do you think is the big unlock with putting equities on chain? Like, do you think we're going to get to a point, and I know I'm not using the correct terminology because I've been corrected on this before, but my like first instinct is to call them bearer assets. But like, apparently there's some difference between a bearer asset, but an asset that you can still custody yourself. Like, there's some differentiation here. But like, what do you view as the big unlock with something like Tesla or Apple or Amazon on chain? Like, is it just the ease of frictionlessly moving it across, various protocols? Is it the self-custody aspect? Like, this is a bit, I do come a little bit from like a Bitcoiner background. And like, this is not so intuitive to me, right? Because like, are you really self-custodying a share of Apple, right? Like, they can scratch your name off their database of shareholders. It's not really the same as self-custodying Bitcoin, right? Like, I think we can all like generally agree on that premise. But like, where do you view, if you had to sell, maybe here's a better question, since I'm being like very wordy here. If you had to sell a Bitcoiner on the value proposition of bringing shares of S&P 500 equities on chain, what would you say?
Yeah, I think there's probably 3 components, and a couple of them probably don't appeal to Bitcoiners. But I think one is like just from like actually the issuer's perspective, which is things are just worth more when the whole world can get access to them. And this is like, I think there's a very reasonable argument actually, even though we shouldn't look at tokens through like a price to earnings lens or any of these kind of things, but like they should trade at a higher multiple, I think, on equal cash flows than in equity because the whole world can get into them. I think that's just like a base level piece. I think the second one is like the global access, which kind of like unlocks that. And then basically the capital efficiency of having things all sitting within the same place. Like when you're actually moving money from crypto to your interactive broker's account to go buy the dip on something, it's insanely slow. And like when you're talking about like assets that have, daily 5% volatility, it actually really annoys people not being able to just have a single account where it's unified and you can actually just decide what am I trading instead of like collateralizing it all in one spot. But I think the opportunity here isn't actually like let me add one more piece to that, which is price discovery moving on chain for like primary issuance of equities is actually quite interesting because I think that's actually what unlocks like 24/7 markets for equities, because you kind of need the price discovery to be happening here in a 24/7 market for the rest of the markets to start to adjust to you afterwards. And this is actually an issue you're going to run into with perps, which is what happens over a weekend with equities when you're trying to price a perp. And so there's all of these different questions which I think actually start to become more easily solved when actually like primary price discovery happens on chain rather than on a venue that's outside of it. That has to obviously take more than decades, I think, for that to like properly happen on chain if it ever does. I think the real opportunity here though is that actually for you to go and compete with Robinhood, it's actually an opportunity for like an entrepreneur, which is like, can you lean into like the reg arb side of crypto, which I think we can openly admit like a lot of these businesses that come and succeed within crypto are. And it's like, can you actually go and do it more aggressively than Robinhood in the beginning and run it harder than they can and use crypto primitives to sort of like drive that wedge yourself? And then maybe you actually become the number 1 perps platform because that's what you're known for and you kind of like won the user through that format. So I think it's actually that kind of angle, which is you can do this more aggressively through crypto rails and actually run at the product harder. And I think that there's quite a long history of people sort of taking that reg arb risk in the beginning and then maybe asking for forgiveness afterwards once they've already won. And I suspect that a few people will sort of take that run in the next sort of 12 to 24 months. Yeah,
forgiveness, not permission, has been like a very lucrative and successful strategy thus far. Like I have no qualms saying that. I guess you worked at a hedge fund, so I'm curious, like I always give a slight bit of added credibility to people who have worked in TradFi, right? Like there's a lot of, and you saw this especially with early DeFi founders, people who were very certain they were going to change the financial system. They didn't know how the current financial system worked. I'm interested when you say price discovery happening on chain, right? Like this was something that I got like way too nerd sniped into, not like at a, extremely mechanism design level, but like MEV and the way that trading on chain works is I don't know, like you worked at a hedge fund. Would you agree it's like generally untenable for the long run of price discovery with very liquid and, valuable assets? Like, where do we converge in terms of price discovery, but also on platforms where people aren't getting, sandwiched and sniped for 10% on, execution and whatnot?
Yeah, I actually agree with you in terms of that market structure piece. Like, I do not think price discovery ever moves on chain, even for crypto. I think it always will happen, and it's actually happened more. If you look at like the percentages of volumes, like even like if you remember back to DeFi summer, right? Everyone used to incentivize those pool twos with their own tokens so that they're trading like the DeFi coins on chain. And now no one even bothers, like when you're doing a new listing, to like even create any liquidity on chain. It's just like, that you're going to have to go to Binance, buy it, and then if you want to bring it on chain to do something else, you do that. I think it's like we've taken a step back actually from last cycle where more price discovery happened on chain and like pool twos with Uniswap, and for the right reason, because they were like extremely inefficient. So I actually agree with your view there, and I don't think that's something that's going to change in any reasonable time period. I think the piece I was more getting to was primary issuance of equity, i.e. you're coming here to actually, issue the shares here within crypto rather than within normal capital markets. And once you're like issuing it in a market where the substantial size of your float actually sits within markets that are trading 24/7, that's actually how you sort of like move the market to that same frequency, if that makes sense.
Hi, this is Charlie, and we at Blockspace are putting on Op Next, a technical scaling conference for Bitcoin. It's coming up here very soon, April 11th and 12th at the Strategy, formerly MicroStrategy HQ in Tysons, Virginia.
Join us on April 11th and 12th for talks and presentations from the likes of Jameson Lopp, Jeremy Rubin, James O'Byrne, John Attack, and many more on the most pressing questions for Bitcoin's future and technical development. Tickets go up in price on April 1st. We're going fast. Get them while they're cheap. And we hope to see y'all there in April.
Go to opnext.dev. That's opnext.dev to get tickets and learn more.
You guys did what I think has been considered like one of the more successful and straightforward airdrops. And I remember this back when you did this, it was like you put your money in for X amount of time and you get, explain to me, like, I guess I'm not remembering the exact specifics, but like I do remember people saying like this was how it should be done. What did you guys see in terms of like the airdrop dynamic, and then like how you guys sort of executed on this?
Yeah, I don't want to take too much credit for it, because I think it's quite easy with Ethena, right? We're trying to incentivize one thing, which is like the supply of USDE to go up. And so when you can more easily define what is the outcome that you're trying to achieve, I think these incentive things become a little bit easier. I think it becomes more difficult actually when you're looking at something like, I think Blast was a good example here, which is like a chain is very difficult to actually decide like how we're trying to incentivize different things, because you don't even really know what the outcome is that you're trying to achieve on the other side, which is like, I want a killer app to come here, but like you can't just like put points out to say, deliver me a killer app. So anyway, I gave that context because it is quite like well defined in terms of what we're trying to do. I think the one thing that we did do differently was I came out in the beginning and I said, it's going to last for 3 months. And this is the time period that we're trying to do it. It's going to be short. We're not going to try like drag this out, because I think I, as a user, had actually sat on the other side of these things for like 2 years and sort of hated how other founders were basically farming me on the other side. And I think people were just kind of like taken aback that someone came out and just said, here are the deadlines, and then stuck to what they said, which it feels like a pretty sad low bar.
Right.
They're like, oh my God, he did what he said he'd do. But yeah, I think that, and it was also during a pretty euphoric moment in the like market cycle. So if we'd done that like 3 months later, I think everyone would have thought it was a pretty shitty airdrop. But I think the timing was very fortunate when we came out. Then yeah.
Yeah. Okay. And then another sort of unrelated question, but it goes a little bit back to your last point. You're talking about like the primary issuance of assets on chain to sort of like facilitate these markets first and foremost. What do you think is the long run of AMMs? Like, I know this isn't necessarily your domain, but I'm just curious. Like, do you view AMMs as being like a critically? Once again, you come from a hedge fund background. I'm always interested to hear people who have like maybe a slightly different take, or maybe not. But like, do you view AMMs as being like critically important infrastructure for this kind of initial issuance of assets, or have they been kind of overblown in terms of their importance?
Definitely not for like a real company that's coming to do like an IPO within crypto or whatever we could do that outcome being. I think the usefulness for them is basically permissionless bootstrapping of the long tail of assets, and that's like it. It's not it's not like actually trading ETH or BTC like at any size or any efficiency. It's basically just saying like, I can permissionlessly come in and bootstrap this thing from zero. And actually they're very useful, I think, for that purpose. So I think they'll actually always play a role so long as you think that like there is trading interest in this longer tail of assets that exist on chain. And it makes sense that price discovery, I think, happens there versus centralized exchanges where you just need a critical threshold of sort of size, liquidity, and interest to get those things going, if that makes sense, in terms of like building an actual order book with market makers. Yeah.
Yeah. Okay.
I don't know if that was an unsatisfactory answer for what you're
No. It's like, I think like I almost always get that same response. I guess my reservation with that maybe is like, I don't know, like the jelly thing with Pump.Fun was like an example of, we're building internet capital markets, right? And these things get like blown up in 6 hours to some outrageous valuation. And maybe that's not even a great example because I have no idea what that guy's doing. Like I have no idea if he's just like absconded with all of the funds or what. Like I'm not like not trying to slander here, but it's like you look at that, it's like, oh, a real business launching on Pump.Fun. And I understand like the notion of being able to like permissionlessly form capital, right? Like it's like such a cliche term, right? But that is alluring. But then when you see this play out in practice, it's like, surely by now we would have seen one of these work out the way it's intended. And I just have so few, like points to look to and say, oh yeah, like this was clearly like a good version of permissionless capital formation. So I don't know. I'm like, I have my own skepticism, but I shouldn't hijack the conversation with that. Okay. One last just like random question I had. So Ethena's synthetic dollar is currently yielding, you said like 18% a year roughly?
Sorry, that was like the average for last year. It's actually kind of at the lows of the last 9 months. It's like 6% as of today. Yeah.
Okay. Regardless, whatever it is, I want to know like what is the long run in your view? Maybe this is like you can give an exact answer, or maybe this is like much more speculative. But what is the long run of like perps funding rates in crypto, and how does this compare to T-bills? Like, I mean, obviously, it's only going to be alluring if it is some amount like greater, I would assume. I'm just curious, like what you view like 5-10 years from now, like where is this synthetic dollar? Like what is the average return higher than, T-bills or some like, less risky, if you will, version of a stable coin?
Yeah, I've got a long answer for you on this one.
Nice.
Yeah, you can kind of, the most interesting quality, I think, of basically the funding rate is that it has a weak negative correlation to rates in the real world. So we kind of saw this in the last cycle, and we saw this in Q4 of this last year, which was when rates go down, people speculate on shitcoins more, and they want more leverage to do that. And so the rate on this product goes up, and that's quite intuitive, like when you describe it like that. That's actually an extremely powerful quality that's compelling to a lot of people, where if you go to TradFi and you say, you've got $100 billion of fixed income that's going down from 5 to 4 to 3, and this is going up from 10 to 12 to 15, that's an extremely like useful thing to basically have sitting within your portfolio. They're always looking for uncorrelated things. The interesting piece that falls out of that is actually, you can sort of think about what we're doing now between TradFi, where I was describing this USDE product, which is actually trying to connect two different interest rate markets, which are quite disparate at the moment. And we sort of saw that between DeFi and CeFi when we first came out. So when USDE launched on Aave, it grew to like over $1 billion in like 2 days, because what was happening was you had a rate in CeFi, which is like 25%, and then a rate within DeFi which was at 10. And so you could just borrow unlimited dollars from DeFi to shove it into CeFi at like a 1,500 basis point spread. That exists at a much larger scale within TradFi, which is like, I can borrow at like SOFR plus 100 basis points, and this thing's paying me 15,000 on the other side. That disparity has to close down in a very meaningful way. And like, actually, you can really think about Ethena as being an interest rate arbitrage vehicle between DeFi, CeFi, and TradFi. And USDE is just a balancing item that's basically forcing the interest rates to converge between those markets. And so that was a very roundabout way of me telling you that I think what's going to happen in the end is TradFi is just going to look at this and say, I want to own crypto credit risk and like cost of capital within crypto at SOFR plus 300 basis points, roughly that number. And anytime the funding rates go like wide of that, we should have just infinite amount of capital that like we'll set up the infrastructure at least that infinite amount of capital can basically come in from TradFi to just push that rate basically back down to where we think the equilibrium should be basically. So yeah, that's my answer, which is I think they'll price it as a equilibrium spread to risk-free rates, and it's just our job to set up the infra so that all the money can flow in to solve for that interest rate.
Yeah, but okay. The one thing I would maybe not push back, but maybe question is like we know that these rates are like you said, shitcoins, right? As we mature, it's less likely to be like 100 vol assets in theory, right? That are being used, like that are being gambled on. So, do we expect it to come down in that sense? Like, right? Like, yes, no, you don't think so?
No, well, more because like BTC ETH is kind of like what's actually sitting behind Ethena, and so long as you believe that people want to long BTC on leverage, i.e., the most bullish asset that's ever been created with the best financial like instrument, so long as you believe that, then like Ethena has a core business model that makes sense. Yeah, if that makes sense. And actually, it actually works in the opposite direction. Sorry to get too like technical on this. Like I think the more that the realized vol of the asset goes down, the more that people want to own it on leverage, and so like. When the vol of Bitcoin goes from 100 to 30, you actually want to own it on like 2x or 3x perps to sort of get the same post-leverage beta that you had the last cycle, if that makes sense.
It's kind of funny because like crypto natives may like intuitively think differently. Just like degens maybe like higher vol, like the more they want to like max leverage. But when you get like real people making real financial decisions, it like completely, switches the chasm kind of.
You have a trade on perps. I'm interested in that. Like, do you touch perps ever, or was it just like long beta too?
Yeah, I mean, like, really, there was like a period of 2 or 3 weeks where I was very convinced that I was an excellent perps trader, and then I was, rapidly humbled. I play around with them, right, but not with like serious money. I know I'm not a trader. I know I don't have an edge. I'm also, for what it's worth, okay, maybe I said that was going to be my last question, but. Do you think that how many people do you think have an edge trading perps? Like realistically, like you see some people on, who's this guy that I think Jordy Alexander's mentioned, High Stakes Capital. He has at least a reputation for being an excellent trader. A lot of us thought that Alex Weiss was a god last cycle. And I think he just kept clicking, right? Super smart guy, but kept clicking. I'm just curious, like, this is a little bit adjacent, right? But like, how many people, and again, you come from a hedge fund background, how many people do you think are actually good at trading perps?
Probably sub 100 or sub 50 in total. I don't think it's a very big number at all. Yeah.
Do you think that TradFi coming in will, I mean, are they just going to wreck people? Like, is Citadel going to absolutely destroy people? Both directionally, I mean, market making, okay, sure, that's always going to be the case, but like, directional trading, like, is Citadel going to come in and just be able to absolutely annihilate this market?
Yeah, I'm not as sure on the directional side of them, if I'm being honest. I don't know enough about them as a firm. Obviously, on the market making side, you obviously expect them to come in and be extremely competitive there. But my guess, obviously, that headline came out a few weeks ago. I think that probably takes a longer period of time to move into like the offshore unregulated venues. That's going to be a pretty big like reg lift, I think, for someone like them to come in and do. My guess is that a lot of the work will be around CME type venues in the beginning, just touching majors, and the crypto native market makers probably have like a little bit longer to sort of keep the offshore venues to themselves, especially on altcoins as well. Yeah, I think it's hard to say you have like a directional edge on like any asset, no matter who you are. It's like a bit of a ridiculous thing to even walk in and say.
That's like the one good thing about crypto still, right? Is like, who's to say that Citadel and Rentech are like that much better than some absolute degenerate on, crypto Twitter with like a penguin avatar? Like, nobody knows what they're doing. It gives you a little bit of hope, right?
Well, I mean, like, I genuinely believe there might be a slight negative, like, inverse relationship there, where like the people who are like truly in the trenches and doing that like professionally as like individuals, I think they're actually like the smartest cohort within crypto, if that makes sense. Like the professional retail people, if that makes sense. The guys who are like actually there doing this every single day, they're actually smarter than the people who are sitting in the institutions coming in and aren't sort of used to the small nuances of this market, I think, which take a while to get used to.
Yeah. I think Kobe probably the Cat. I heard Cat or CL 207 or whatever. I heard them on a podcast one time. It's like it almost always speaks in some ridiculous, way on Twitter. But then I heard them talk about their trading. I was like, okay, I think this person actually knows what they're doing. So I think you're right. The professional retail definitely still have some degree of an edge. Okay, one quick last question, just because we've now diverted a bit from the original topic. Do you think that a lot of the value ends up being captured in this kind of order flow dynamic? We see Citadel, we see Robinhood. Is this a big sort of impetus for these institutions wanting to come in? Not necessarily the BlackRock side, but more the trading firm side. Are they viewing this as just an absolute, shooting fish in a barrel type order flow dynamic for them?
Yeah, I think so. Especially I'm not a MEV expert, especially on Solana, but you can just look at the dynamics that you see there from the value chain from pump all the way down to Sol. There's just an insane amount that's sort of leaked in every element there. So yeah, I don't see how they look at that and don't think that's interesting. I think the more, and again, I'm not a MEV expert. I know we're going down these avenues quite a bit, but there is a red question I think around it, which is is most of that not sort of front running people in some format?
For sure.
It's a huge just legal question around, is the entire MEV industry even legitimate? But yeah, I think especially within crypto exchanges as well, if you just actually look at the volumes relative to market cap for crypto versus equities, just people just trade way more, they cross the spread way more, they use more leverage, and just all of these things are just obviously interesting pieces to professional market makers coming in.
Yeah. Well, awesome. This is a great conversation. I'm really glad we got to also branch out and just get your perspective on a lot of other things. So thanks so much for coming on. I really appreciate it.